My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. People make friends. I'm just trying to make a little money. My job is not just to entertain, but to educate, teach. Call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Suddenly, all is forgiven. Or if not all, then at least most is forgiven. I'm talking about the incredible resilience in this market, fueled by a recognition that so many companies are simply better than what Wall Street thought. So we need to stop turning against them every time there's a single seemingly bad data point. Every day I come in work and I'm just dazzled by the resourcefulness of executives who do their best to create value for you, the shareholder. Lots of stocks go up on days like today, where the Dow advanced 235 points, S&P gained 0.75%, NASDAQ jumped 1.0%, simply because of good management and excellent execution that too often goes unnoticed. Listen, I'm not a Pollyanna. I can hit CEOs with withering questions if I have to. Some of them deserve scorn and skepticism. But there are plenty of brilliant, hardworking CEOs with incredible, hardworking teams, and you ignore their hustle at your own peril. Now, this often gets lost in the shuffle when we're focused on the parlor game of guessing the Fed's next move. A quarter, a half. Hey, you know what I say? Let's get serious. Terrific companies do not get caught up in the quarter-half shuffle. Case in point. Today, we got results from Kroger, the nation's largest supermarket chain, is trying to buy Albertsons despite harsh resistance from the regulators. Now, you might think Kroger would be distracted as it tries so hard to close on this deal, and that's what many analysts certainly assume. But it turns out the reverse is true. CEO Rodney McMullen's managed to keep food costs down and deliver fantastic numbers, all while maintaining an expensive unionized labor force in a very uncertain commodity environment. How? I think that Kroger confounded the critics by developing a superior loyalty program, regionalizing their stores, and creating some of the best store brand private label products out there, second only to Costco. Food's still expensive, but cooking at home is far cheaper than going out. McMullen tells us that the consumer is no longer flush, and that goes double for his most budget-conscious clientele, and he's got one. Now, though, he points out, quote, budget-conscious customers are buying more at the beginning of the month to stock up on essential items and groceries, and then as the month progresses, they are more cautious with their spending, end quote. Wow, that's a tough environment. And when I heard this, I thought back to the old Kroger, the one that would perpetually miss its numbers whenever the environment got a little tough. Everybody else remembers the old Kroger, too. Maybe that's why the stock was just sitting there waiting to be had until the quarter was reported, and it soared more than 7% in response to the fabulous results. Everybody thought Kroger would drop the ball like they used to, but McMullen's finally whipped his supermarket into shape, hence the amazing rally in KR. Now, as stocks go, this is a pretty straightforward story. We all need to eat, so it's not that hard to get your head around the grocery business. But it's quite different when it comes to tech, where the analysts are constantly doubting the resolve and perspicacity of CEOs who simply know far more about their own business than the critics. In tech, the complexity is such that Wall Street often reaches conclusions that have little to do with reality. Consider the case of Amazon. All aboard! The most important component of Amazon is not the store for Amazon, it's Amazon Web Services, AWS, because their cloud infrastructure business has the best gross margins and can produce the biggest upside surprises. Sure enough, after a couple of suboptimal quarters, what management called optimization, which is tech speak for customers who committed fewer dollars because they were worried about the economy, the web services business has exploded. It keeps getting better and better thanks to generative AI. And that caused me to love Amazon's last quarter. But the street hated it. Sell. Because Amazon Prime had a couple of weak shopping days, including an otherwise great Saturday where business slowed down because someone tried to assassinate former President Trump. Soon after then, the nation was transfixed by the Olympics, so Amazon feared that could slow impulse spending too, until they were over and maybe bounced back. Next thing you know, the stock, it is in free fall. Falling from 184 to 154. I was jumping up and down telling club members of the investing club to just go buy it. We bought it ourselves for the charitable trust. I made it clear that I had total faith in CEO Andy Jassy, and it's just business as usual at Amazon. Oh, I know I came off as a houseman for Amazon. I was aware of that. I was walking around the beach. He still loves Amazon. But I really don't care. You see, Jassy's a little like Coach Andy Reid from the Chiefs. You can expect him to do what's necessary to win. Today, Amazon stock traded back above where it was before the so-called horrendous quarter. You were rewarded if you stayed with it and you bought more when they were just giving away the darn stock. How about Broadcom? Yes, one of the hardest stories to understand because there are many moving parts that aren't well known. In fact, unless you study the underlying plumbing that extends from the data center to the internet or from the cloud to the data center, you probably not even know Broadcom's core growth driver. When these guys last reported, the stock fell from 153 to 137, even though it beat expectations because people didn't like what they heard about the AI portion of the business. Of course, Broadcom told you that its AI biz remained in turbocharged growth mode and that its VMware acquisition, the business I was actually worried about, had turned the corner and gotten very strong. Almost nobody listened when the company told you all was well in AI. I was not concerned about the AI division. Why? Because Hock Tan, the bankable CEO of Broadcom, told us not to worry. He told us the AI business was going to accelerate. Instead of joining the negative fray, I said to myself, why should I doubt this all-time great coach when he's been right for ages? Now the stock's up to 164 and change, well above where it was trading right before the so-called bad quarter. If you'd simply given this tremendous CEO the benefit of the doubt that he deserved, you could have made a fortune in less than a week. Naturally, best for last, NVIDIA, where we got a huge quarter last month, yet all we heard was how disappointing the numbers were. Yeah, cancel the watch parties, NVIDIA. No more tailgating for NVIDIA. The stock was traded about 126 before the quarter was just laid to waste. It fell to 102 at its lows last week. The world had given up on it. But they didn't even know why or how. They didn't even know what NVIDIA does. They certainly can't pronounce it. They pronounce it like Nivea cream. This week, those who panicked and dumped the stock, well, guess what? I think they're trying to remember why the heck they did something so stupid. We've now learned that demand is so strong for Blackwell that that's a new supercomputer chipset that is shipping in volume. That CEO will this year. CEO Jensen Huang says clients, I love this, are getting emotional about it, emotional about allocation. That sure doesn't sound like NVIDIA's got a demand problem, as many critics speculated at the time. It sounds a little more like, hey, they got too much demand. Plus, Jensen talked about the other huge part of the business, accelerated computing. No one talks about that, which uses NVIDIA's ultra-fast graphics processor unit to handle anything intense, rather than the CPU, which is usually made by Intel. Much more energy efficient that way, not to mention way faster and cheaper when it comes to energy consumption, which has become the key variable when we're talking about the total operational cost, TOC, of semiconductors. Next thing you know, the stock's at 119. Can it get back to where it was before the so-called horrendous quarter? Can it get back to the 127? I don't know. All I can say is, why not? Look, it's right to be skeptical when you're investing. It's right to be jaundiced. But the bottom line, not every executive deserves the same level of skepticism, if not scorn. Some CEOs have earned your trust. When we're talking about execs like Rodney McMullen from Kroger, Andy Jassy from Amazon, Hock Tan from Broadcom, or NVIDIA's Jensen Huang, I'm giving them the benefit of the doubt. Maybe you should, too. Why don't we go to Ian in North Carolina? Ian.
Jimbo, how we feeling?
I don't know what's shaking with you, Ian. I'm feeling pretty good. What's happening?
Yeah, every day's a holiday.
Really? I hadn't thought about that. What holidays today? What were we celebrating?
We got football back on. I know it's week 2, but hey.
Right. North Carolina's got the Panthers. I forgot.
Yeah, we're real excited about that, Jim.
Yeah, everyone is. We're just I'm taking all your guys in fantasy because I'm trying to throw my league. Then everyone will love me, right? Everyone will love me. I'm just throwing the games. Okay, let's go to work.
Cool. One of my old favorites from the COVID era is up 21% this year. With rates dropping and a large short interest, do you think now is a good time to double down on Upstart?
I think that's tough because if the economy gets tougher, Upstart will get hurt. I do prefer, if you're in that area, Affirm, which I think is doing quite well. And Max Levchin, you know what? He's delivering. People were skeptical. He's delivering. Mandy in Maryland. Mandy.
Hi, Jim. How are you?
Mandy, I'm pretty good. Every day's a holiday.
Oh, that's wonderful. Glad
I just thought of
it. Love your show.
Thank you.
For teaching us how to invest.
Oh, thank you. You know what? That is the goal. You hit the goal. You're very kind. I expect everyone to learn, emulate, and they'll be teaching the next generation. How can I help you?
I have a small position. I bought 8 shares at 180. Shall I keep buying, or should I just stay put and hold on to what I have? The stock I have in mind is NXST.
Next Star Media. You know, I saw Parisuke at dinner. I was at a restaurant recently at Porterhouse, and I just congratulated him. He's doing such a great job, and the answer is you should buy more. Buy another 2 before the election. I think it's definitely the right place to be. Thank you for the kind words. Okay, listen to me. In this market, I think it's worth giving some CEOs like Hock Tan, Andy Jassy, and Rodney McMullen the benefit of the doubt. I think you should too. I didn't be too flip about every day's a holiday, but I had it in my head and I really liked it. Anyway, on Mad Money tonight, we get calls all the time asking if Cava could be the next Chipotle. So I'm going straight to the source with Cava's CEO to see where the fast casual chain stands in the pursuit of growth and the pursuit of value. Then Callaway merged with Topgolf, and let's just say it's been a big mess that unfortunately I got wrong. I got to own that. A lot of stocks to do right, some stocks to do wrong. And Signet Jewelers shine bright like a diamond in today's tape, and I'm getting the latest in the quarter with the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Some stocks just don't know when to quit. Take Cava Group, the fast casual Mediterranean chain that came public a year ago. I started recommending this one at $32 last November, and it's now trading at $125 and change, thanks to a series of strong quarters. Heck, it's up 192% just since the beginning of the year. The last time Cava reported toward the end of August, they delivered a tremendous quarter, 14.4% same-store sales growth, fueled mostly by 9.5% uptick in traffic, which is exactly what you want to see in this environment. Since then, the stock keeps roaring. How long can it climb? Let's check it with Brett Schulman. He's the co-founder and CEO of Cava Group to find out more. Mr. Schulman, welcome back to Mad Money. Good to see you.
Jim, thanks for having me. It's great to be here.
Okay, but you had one of the most incredibly exciting accelerations in business that I think I can ever recall, particularly in the restaurant and service business. Did you see this surge in growth?
Well, we always believed in the potential of Mediterranean as the next large-scale cultural cuisine category. And after going public, we saw that awareness really grow across the country as we expanded across the country, and that's really helped drive the traffic results you saw last quarter.
Well, let's talk about Chicago for a second, because I want to celebrate what you're doing. You open in Chicago. You have opened a couple of stores, 3 stores, and the next thing you know, it's blowout. How did people had heard of you, and why was that opening so strong?
Well, you know, it's interesting. We've had a lot of people. We're 14 years old, so we've had a lot of people that have lived across the country. We operate in 25 states in the District of Columbia. They've experienced Cava. They've been asking us to come to Chicago for years, and we were so pleased with the warm welcome we got in the Chicagoland area.
All right, when I read that and I said 341 stores, you could put up maybe 1,000 stores. That's how I feel about Cava.
Well, we have a target of 1,000 restaurants by 2032, and that basically implies a 15% plus compound unit growth rate from here to there.
That is incredible, and I believe you can do it because you are, as we call it, law school, sui generis. Now, I'm going to ask you to explain to people what the difference is between price and value.
Yes, I've talked about this a lot lately. I think the value wars are a bit of a misnomer. I think those are more price and discount wars. Price is what you pay for something. The value is what you get, the worth of what you receive. And we frame value as a combination of attributes. So the quality of our food, the relevance of that great Mediterranean cuisine, that on-trend cuisine that's unique, where taste and health unites, the convenience in which you can access that cuisine, whether it's our 45-plus digital drive-through pickup lanes or digital order or delivery to your doorstep, or the experience you have when you come into our restaurant and experience our interactive walk-the-line format and that great Mediterranean hospitality our team members deliver.
Well, now let's talk about the notion of on-trend and how long a trend, when is a trend an actuality? Is it not true that people who are, say, between 18 and 26 care more about their health than any generation before them?
Yeah, Jim, you're seeing large-scale secular trends that, on the one hand, the country's getting more diverse. 48% of Gen Z identify with an ethnic minority group. That's up from 39% of millennials. Gen Alpha will be the first to cross the 50% paradigm. And what we see and what we know is, as the country gets more diverse, people's palates are broadening out, seeking bolder, more adventurous flavors. But at the same time, they're becoming more interested in health and wellness trends and understanding the food they're eating and how it impacts them. And that's where Cava comes in. That's where our Mediterranean cuisine comes in. that unique cuisine where taste and health unites.
Well, you've done something ingenious. Now, I have a vegan daughter, and she loves kava. How can a vegan not? But then you put steak in. So now I want to order it as well as her. That was a pretty smart move to be more inclusive.
Yeah, well, we've always been pretty balanced, about 55% male, 45% female. And then our day part mix, where 46% of our occasions are at dinner. So we're not just an intuitive choice for lunch, but we're an intuitive choice at dinner. And we say we want to welcome everyone to our table. And I think that's what's so great about our food is, and within 38 ingredients on the line, you have over 17.4 billion combinations, whether you're a meat eater, whether you're a plant-based eater, whether you're a flexitarian eater, or I know, Jim, you don't like garlic in your bowl.
It's true.
So you can get a bowl without garlic, so everyone can be happy at Kava.
Well, one of the things that shocked me is that I thought steak would be great for dinner. It turns out it's a boon for lunch, too.
That's been a pleasant surprise for us. We really had confidence it was going to be strong at dinner, but we've seen it adopted just as well at our lunch occasion.
Now, you introduced the concept, at least to me, the post-inflationary environment. That's what you say we're in, but at the same time, either you know that people are struggling. There's an element of struggle among everybody's daily life, but you also know that there is a value proposition that I believe will only be enhanced when you bring in your loyalty program in October. So I'm thinking there could be an acceleration of numbers here.
Yeah, well, we're always mindful. Our philosophy is we want to invest in our team members, we want to invest in our guests, and that will create long-term sustainable restaurant level margin expansion and shareholder value. And our loyalty program is just another part of that equation. So we're excited in October. We've had the same to launch this program. We've had the same program for over a decade, and this is a new earn and bank points model with a catalog, a menu of reward redemption options, so you can redeem your points on your terms for your favorite Kava item.
Well, I think that's very, very smart. Project Soul. We got to talk about that. What does it mean?
So this goes to what we feel like is this consumer convergence in the restaurant industry that we sit at the nexus of. We're seeing trade down from traditional full-service casual dining. When you think about that value proposition I talked about, quality, relevance, convenience, and experience, we see people still want to share a meal in our dining rooms. 65% of our customers come in our restaurants. We have great convenient digital channels, but we want to have great experiential channels. You know, sharing a meal is the oldest social act known to humankind. And as technology and automation permeates the front lines of many concepts in everyday life, people are craving that connection. And we want to be a place where you can feel that connection and you can have the warmth of our new Project Soul dining room with our enhanced brand palette, enhanced greenery, and softer seating to eat your favorite Kava meal.
Now, against that, I want to talk about this notion of price and value. Today, McDonald's said they're going to keep the $5. Again, that's not really. Are they in the same business as you?
I think we're in a different business in a sense, and I don't think you can discount your way to prosperity. We really want to focus on the guest experience and the total value proposition and the quality of what we're eating. And what we're seeing is consumers are willing to pay $1 or $2 more, sometimes at parity, with the accelerated price increases of fast food in the last few years, and they'd rather have a fresh bowl of Mediterranean food than a traditional fast food meal.
Well, look, I think now, people, you can see why this stock has been so good. There's an ethos, there's values, there's quality, there's execution, and there's Brett Schulman, co-founder and CEO of Kava Group. Great job.
Thanks, Jim.
Mad Money's back after the break.
Coming up, work on your short game. Cramer's in it for the long run. Land on the green. Next.
Every now and then, you need to look back on your mistakes, figure out where you went wrong. As much as I hate losing, at least it's a learning experience. So less, never told to learn. Which brings me to Topgolf Callaway Brands. The company created nearly 4 years ago when Callaway, the golf equipment and apparel maker, merged with Topgolf, which runs these high-tech driving ranges that got so popular during the pandemic. I've recommended Callaway repeatedly over the years, most recently in April of last year when the stock was in the 20s. Now it's at $9 and change. In retrospect, it's not hard to see where this one went wrong. Callaway bought Topgolf in March of 2021, and the market lapped it up. Because in those easy money days, investors love paying for growth at any price. CEO Chip Brewer was effusive about the deal. He talked about how Callaway fits perfectly with Topgolf's technology platform. But after it closed, the stock peaked at $37 a few months later, only to spend the next 3+ years stuck in a sickening decline. Again, today it's at $9. It's gone so badly that last Wednesday night, management decided to pull the plug. The company is now breaking itself up, spinning off Topgolf as a standalone public company. No harm, no foul. I don't know. Even that hasn't helped the stock. In the 6 trading sessions since the announcement, it's fallen another 12%, because this is a clear admission that the whole merger was doomed from the start. Now, full disclosure, I bought into the hype and was hopeful about the Topgolf acquisition at the time. I told you to pull in your horns on this one in April of 2022 because the market had turned against richly valued growth stocks. When I circled back to Callaway a year later, I was much more bullish because the stock had already come down so much. Obviously, that was a real bad call. So what happened here? What went wrong? Why didn't the Callaway Topgolf merger work? Okay, for starters, let's not forget that golf had a moment during the pandemic. Because you could play with your friends outside without putting yourself at risk of catching COVID. Now, I thought that would last post-COVID, but that turned out to be a little too optimistic. Golf has tapered off a bit. The National Golf Foundation tracks aggregate rounds played, which declined by 3.7% in 2022. They started picking back up, 4.22% last year. In the first 7 months of this year, though, rounds played inched up 1.3%. That's just okay. But when Callaway decided to buy Topgolf in 2020, rounds played were up nearly 14% year over year. They were up 5.5% in 2021. Obviously, this high-tech driving range looked a lot more attractive when we had lots of new golfers. But now the industry's growing at a much slower pace, and of course, that's going to crush a stock. It certainly doesn't help that this is an expensive sport to get into at a time when people have cut down on their discretionary spending. Maybe more important, there's lots of new competition. Pickleball's taken the world by storm over the last couple of years, and it's so much easier to set up a pickleball game than a round of golf. That's what happened to golf itself. But there is a much simpler reason why the Topgolf acquisition blew up in Callaway's face. The concept fizzled. When you look at Topgolf's same venue sales, they were growing by double digits in the first half of 2023. But in the third quarter of last year, they were up just 1%. And by the fourth quarter, they were down 3%. As for 2024, same venue sales sunk 7% in the first quarter and then 8% in the second quarter. When we learned of that first major deceleration from Topgolf in November 2023, JP Morgan's Matt Boss shrewdly downgraded the stock from overweight to neutral, citing data from our friends at 100X. The consumer insights firm. Basically, people had stopped seeing Topgolf as good value proposition over the previous 3 years. It seemed too expensive, something that's become a real problem over the past couple of quarters, as consumers finally started pushing back against high prices. If you look at the most recent quarter, which Topgolf Callaway reported a little over a month ago, well, this was another disaster that sent the stock down nearly 20% over the following 3 days. Topgolf's same venue sales were down 8%. Management basically admitted that things wouldn't be getting better anytime soon. CEO Chip Brewer threw in something interesting on the conference call. Topgolf's consumer business isn't doing that badly. It's the corporate/event side of the business is getting killed. He explains this is a, quote, normalization from a post-COVID surge, as well as softness in demand, typical of slowing economic conditions and corporate belt-tightening, end quote. He sees it continuing through the current quarter, too. So basically, Topgolf fell apart because, one, it's simply less popular in a post-pandemic world, and two, management became overconfident in its popularity. They got aggressive on pricing, but the whole point of Topgolf was about bringing in people who might not be willing to shell out $100 or more to play a full round of golf. Callaway bought Topgolf to get itself a new growth driver, but now it's not even growing. At the same time, the Callaway side of the business, meaning golf equipment and active lifestyle apparel under a bunch of different brands, is now shrinking too. Some of that's because there's a lot of competition in golf equipment right now, and Callaway's brands don't seem to have a ton of juice compared to their rivals. I have to wonder if the combined company underinvested in the golf equipment and apparel side of the business as it committed lots of capital to building new Topgolf locations. Perhaps more important, turns out there are never any synergies between Callaway and Topgolf anyway. Callaway makes golf products. Topgolf runs golf-centric entertainment venues. Really not a lot of overlap. I should have been more skeptical at the time, but this was during the pandemic when Topgolf's growth rate was truly incredible. Now that Callaway's spinning off Topgolf to undo the acquisition, they're basically admitting that this whole thesis was bogus. Now, all that said, I think a standalone Callaway has the potential to turn itself around. Could be a good value stock once it's no longer got the Topgolf albatross around the neck. But here's the bottom line. You need a healthy amount of skepticism to survive in the stock-picking business, and I was never skeptical enough about Callaway's acquisition of Topgolf. I hope these two businesses can turn things around once they break up, although I'm a lot less sanguine about the Topgolf side of things. For now, this is just a pure corporate tragedy. Let's go to Tyler in California. Tyler.
Hey, Big Booyah from California. How you doing, Jim?
I'm doing well, Tyler. How about you?
I'm doing good. Thank you for asking. What are your thoughts on holdings?
Okay, as negative as I am on Nike, and I have to admit I am a tad negative, I think on is good. I think that they're doing a lot of things right. There was one fly in the ointment. You used to get pebbles in the soles. They fixed that. They're doing really, really well. And I've got to tell you, Adidas is doing well. Hoka from Deckers is doing well. Everybody other than Nike is doing well. But I like on very much. Let's stick with questions. Let's go to Russ in North Carolina. Russ.
Hey, Jim. It's so good to talk to you. Thank you for your many years of service and your education. It's been awesome. And the ticker symbol that I'd like for you to analyze is FDX. I know earnings is coming up next week, and they're in the middle of cost-cutting efforts. And I just wanted to know what you thought about the stock. And thank you.
Of course.
For
Now,
your
first,
many
Russ,
years.
I thank you. Thank you for those kind comments. We had a long day. We had the investing club meeting today. And when I hear something like that, I say to myself, just keep working, keep doing it. As for your stock, FedEx, I think Raj Subramanian has done a remarkable job. I think it's a multi-year turn. Nothing is going to be too blowaway, but I think you should be in the stock ahead of the conference call because I think he's going to tell a real good story. Now we're going to go to Josh in Florida. Josh.
Jim, with interest rates coming, what are your thoughts on SoFi Technologies into year end?
I think you buy SoFi into interest rate cuts. It is down 25% for the year, even though it's incredibly well run. To me, this seems like an opportunity. Anthony Noto has come on several times. We did need to see some news about rates, but we also, frankly, I would like to see people so equate this thing and conflate this thing with student loans. It would be terrific to see, of course, if you were a student loan, don't want to hold your ears. It'd be terrific to see that if you maintain the payment of student loans, it does help SoFi psychologically. It's really a fintech, and that's what matters. All right, look, I think a standalone Callaway has the potential to turn itself around. It could even be a good value stock once it gets out of its Topgolf sand pit. Much more made money at, including my exclusive with Signet, the jewelry company. With the stock soaring over 11% today, I'm getting the latest on why Wall Street has fallen back in love with this court when I sit down with the CEO. And there's a lot to talk about there. Then there's a new head at the helm of Starbucks. I'm sharing what I think you should do with the stock amid the leadership change. And of course, all your calls, rapid fire, tonight's edition of the Lightning Round. So stay with Cramer. Love is in the air, at least on Wall Street. This morning, Signet Jewelers, the parent of Kay, Zales, Jared, Blue Nile, and several other brands, reported a quarter and sent the stock flying 11%. How did they pull it off? In truth, the actual results were good. But bulls lapped it up because Signet's being graded on a curve right now. Jewelry's expensive after all. High interest rates make it harder to borrow money to pay for an engagement ring. Plus, entering today, the stock was down 28% since its last quarter in May. In short, Signet roared today because maybe it was better than feared, but can it keep improving? Let's take a closer look with Gina Droso. She's the CEO of Signet Jewelers, who joins us now and does in good and bad times, although the times have been mostly good. Ms. Droso, welcome back to Mad Money.
Great to be here, Jim. Thank you.
Okay, today was a very important day because today was the day that you signaled that something could be in the air, besides love, that's changing things. New trend in engagement rings. That makes me feel more confident this was not a one-off. Things could be getting better.
Yes. So we had predicted that engagement rings would experience their COVID about 3 years after lockdowns, because that's the normal amount of time that it takes for a couple between when they meet and when they get engaged. In fact, that's exactly what happened. In 2022, we saw engagements down 12%, 2023, 25%. We said about this time we would see engagements become, popular again. And that's exactly what we're seeing. We see it in our results. We've had positive engagement units Q3 to date. We also see it in data like Google search, Instagram search, and some milestones of dating that we track.
Well, I have to admit, I was concerned. I knew you were coming on, and I was worried. I'll tell you why I was worried. Because of rates, because of interest rates. I mean, it's a discretionary item. People want to jewelry. They can trade down. They don't necessarily have to go up to your more expensive units. But it didn't work out like that, did it?
Well, we thought that engagements might come back a little faster, but there is a cautious consumer. So what we're seeing is that there are more couples that at any time in the last several years who are ready to get engaged, but they may be just taking a little bit longer as they're shopping. A good statistic on that is that we see people coming to our websites 15% more than they were just a year ago, so that they can search and browse and make sure they're getting the right thing.
But there's also a trend in fashion that makes me want to go to the website to see what you got new. There's a newness theme that you have done. You've always wanted newness, but you've accelerated.
We have accelerated newness. Newness is a great story in the quarter. It was up 50% versus last year, 25% of our sales, which is 800 basis points higher than last year. We've really accelerated. It's on trend. It's at the right price points, and consumers are buying it.
All right, so we're heading to holiday season. Tell us what is on trend so we know what to buy.
Yeah, it's a great time, I think. There's a lot of innovation that we're bringing. So one is sculpted gold. Gold prices are high.
Right.
But Steve,
they're all-time high.
But people still love a big look. And so we have a technology called sculpted gold, which has a hollow center. So you get a very big look without the heaviness and without the cost. Okay. So great on that. We're seeing a lot of good new ideas in fashion. Lab-created fashion was up double digits in the quarter. Natural diamond fashion is also good. Tennis bracelets, tennis necklaces. In fact, Zales just did a collaboration with Prince at the U.S. Open for tennis bracelets and all, really some beautiful fashion jewelry. So lots of good innovation.
Could tennis go from being fashion to be something staple? A lot of people traditionally like to give that look. Is it something that's really special, you think, for multiple years for you guys?
I do. I think tennis bracelets and tennis necklaces are really trending right now, mostly for women, but also for men.
For men?
Yeah. You should consider
that's a surprise.
That's a surprise. Yeah.
Service revenue continues to be a bright spot. Just kind of an annuity now.
It is. So we've grown our services positive comp the last 8 quarters in a row. So that's a great story. It was up 1.4% the quarter. And remember, services are an important relationship builder for us.
Explain that to me.
So once people buy a piece of jewelry, they come back to get it checked. We make sure the prongs are tight. We polish it up for them. Right. It's just a way to see them over time, which I think is great. We take great care of their jewelry. It's like you wouldn't buy a car without, taking it in to get it serviced. It's the same with your jewelry, and we can provide that. So it's very strong.
Okay,
and it's a high margin.
Right, because I just figure I want steadiness. And one of the reasons I want to, and I want to talk about this, is that you and I both know your stock is inexpensive, and you buy back stock. You're also always fixing the balance sheet from the day I met you. But sometimes I feel like that you've got, and I felt this last quarter, you bought so much stock in that the stock trades as if it's like, it just doesn't trade smoothly. And I'm wondering how to change that. I mean, you could be underneath you because you did your buyback you did not do a buy road buyback. You waited till it was the right moment you bought. But we just want the stock to be a little less herky-jerky. I don't know what to do. Any thoughts about how to make it so it's kind of less crazy?
Well, I think one thing is just in the business itself. I mean, we're really making ourselves, more inflation-proof, more macro-proof by having a good, better, best assortment. So we have something for everyone at the right price point. That's why the newness is doing so well. I think within the stock, giving back capital to shareholders has really been a hallmark.
Fantastic.
Over $2 billion in my tenure of share buybacks and dividends. And that's something that's very important to our management team and our board. So I would expect that to continue. We'll buy the stock when we think it's a great value. We have a growing dividend. So continued with our great balance sheet, continued opportunity. Remember, our preferred shares come due in November. And that, combined with our other actions is really eliminating 15% dilution in the stock. So that's a good thing on the horizon.
Last question. Where are you going to let us go with you for the holiday season so we can see the newness ourselves?
Oh, we should definitely be in store. We've put a lot of money into stores this year. It's our biggest year of store investment. We have 300 renovations that have been happening already and will be completed by holiday. So we should go to one of our new concept stores and see all this newness and all the engagement rings because, as you said, love's in the air.
Yes, it is. These people should get on the case and stop waiting. They don't know what they're missing.
It's true.
Anyway, that's Signet Jewelers, CEO of Signet, SIG, and we will see each other together for a holiday extravaganza of the best stuff you have.
Sounds great.
Everybody's back in.
Coming up, Hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time for the light round. Christian Reds about Robert Gold calls. He's heading to the stock. I tell you about advice. Also, sell just to be clear on the stock. The right step for grams of light. Play this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Crazy Let's start with Joseph in Florida. Joseph.
Hey, Jim, go Birds!
Go Birds. What's happening?
What's happening? So, Jim, it seems like the worst is behind Com, right? They look like they have a forward PE of 3, which seems too low. If they now have earnings, what's a good multiple for this company?
Okay, we're talking about COM, which is CommScope Holdings. The stock has been on a real tear. And you know what? I don't know why, which therefore means I can't opine and I must do homework. And I thank you for that. And go Eagles. Gene in Illinois. Gene.
Hello, Mr. Cramer. Thank you again for taking my call. And
of course.
With your keen insight. Hope you and your family are healthy and doing well.
We're doing okay. Thank you for asking. Hope same for you.
Okay. There's been a lot of recent buzz about quantum computing, and I want to ask your opinion on one of the pioneering companies in this space. That's IonQ, symbol IONQ. I've heard good reviews and bad reviews.
Well, Gene, I've got to tell you, I'm going to cut right to the quick. It loses too much money, and when it starts making money, even if it's higher, I'm going to take a hard look at it. But the companies that are losing money right now get no traction. Mark in Massachusetts. Mark.
Hey, Jim, how are you?
I am good. How are you?
Good. I've been playing a lot of golf, and I've been looking at the fitness watches, which led me to Garmin, Grmn. Just wanted to get your thoughts on that.
They have unbelievable fitness watches. I happen to be a boater and a fisherman. They've got Angler. They have unbelievable fishing equipment. I've got to tell you, Garmin is the real deal. We profiled it a long time ago and said, you know what? This company has it going. People have given up on it. They're quite wrong, and you are dead right. It is going higher. Peter in Connecticut. Peter.
Hey, Jimmy. Booyah, Jimmy C. How you doing?
Thank you. Booyah, right back at you. What's happening?
Yeah, I was just wondering, what about Conterra? Would you say?
All right, it's the only oil company we have left. You got to listen to You got to go listen to our recap of our conference call that we did today. Jeff Marks, our club call. We had a meeting, and I talked about how hard it is to own the oils. We only want to own Coterra and nothing else in that group. Warren in Arizona. Warren.
Hey, how you doing, Jim?
Good, Warren. How about you?
Okay, not bad. Hey, Jim, the first time I heard you, I think was in 1998 when your first stock was Hertz back then that you were talking about, that I heard you.
Previous Hertz, but absolutely. Jalen Hurts, I think, at that point. I don't even know if he was born yet. Go ahead.
But anyway, I have a stock I like to know about, Bank America.
Okay, Warren, get this. There's another Warren that's destroying the stock on a daily basis, Warren Buffett. I think the stock snaps back the moment we sense that he's so far sold so much that he can't hurt the stock anymore. It holds up rather well given the fact that he's selling 11 times earnings. That's the one we want to be, and I like it. Let's go to Ian in Florida. Ian.
Hey, Jim. Booyah from sunny Florida.
There you go. You got the edge on me, partner. What's happening?
Jim, just wanted to let you know I'm a third-time caller, club member as well.
Oh, yes. Hope you enjoyed today's club meeting. Jeff Shine with that Home Depot review. What's going on?
I thought it was great. Great meeting. Thank you for all you do for us.
Thank you.
Jim, I got a question about a stock that's well off its highs of 500 or so, and recently had some good earnings about a month ago. So it's up a little bit, but I really like the stock. It's MongoDB.
You know, that was an enterprise software company that put up terrific numbers and is not getting credit in the same way that Salesforce is. And people hate enterprise software other than ServiceNow. I think MongoDB is at the right price. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
An Investing Club member hit us with a real interesting question the other day. Question about Starbucks. They wanted to know why we hadn't sold some for the Chapel Trust. given the stock's remarkable resurgence ever since Brian Niccol was appointed CEO. See, it was at $75 a little more than a month ago before he was named chairman and CEO, and now it trades at $99. That's a Lazarus-like transformation. My short answer is that Niccol, late of Chipotle, is a superb operator who has a way about him that inspires you, makes you play above your game, allows you to shine. Starbucks has serious problems, but so did Chipotle when he took the helm there in 2018. At the time, the stock was at $6 and change, devastated by repeated foodborne illness outbreaks. The restaurant managers, top to bottom, seemed paralyzed, clueless about what to do. Now the stock of Chipotle is at 56, in large part because of the inspiration and execution Brian brought to the company. I initially thought Niccol, coming from Taco Bell, was an odd choice. After all, burrito at Taco Bell had a ton of ingredients, many of them seeming like they belonged in a chemistry class. A Chipotle burrito had 8 ingredients, though, and was all natural. I questioned the choice on air. I thought he'd never talk to me after that. I could have been wrong. Niccol wanted to learn from me, learn from anyone. And he ultimately orchestrated one of the best turnarounds I have ever seen. Now, earlier this week, he put out a common-sense letter with his plans to restore Starbucks to greatness. The letter did 2 things his predecessor never did. 1, explain that there's plenty wrong. And 2, make clear that he wasn't going to let anyone else control the process of fixing it except for him and what I suspect will be a hand-picked team like he put together at Chipotle. While Brian sees plenty that he likes, he knows that the blocking and tackling, the throughput, is wanting. And the very idea of what Starbucks seems to have, let's just say it's gone awry, gone away, big issues. And they include things that really troubled his predecessor, like a disturbing and at times violent boycott that kept scaring off important occasional drinkers that couldn't therefore be converted to regular customers. Instead of paralysis, which is not a strategy, Brian said he sees, and I quote, enormous potential for growth, especially in regions like the Middle East, where we'll work to dispel misconceptions about our brand, end quote. I don't know how he's going to do it, but I sense he's got ideas that are already better than the previous regimes. My real confidence comes from going back and reading his first 2 conference calls after he took the reign at Chipotle 6 years ago. He did it last night. It was really incredible. See, the similarities turned out to be almost eerie. He figured out what was working right back then and what needed to be changed pretty much immediately. He recognized simple mistakes that were being made, noting that experience and controls were wanting, and he made it clear that he wouldn't tolerate anything less than total customer satisfaction. That's exactly what he needs to do at Starbucks. I was hoping that Brian might consider a 2-store solution, one for mobile orders and one for the fabled third place that Starbucks used to be. But my ideas are going to seem pedestrian versus the ones in his head right now. He knows food marketing better than pretty much anyone. So I'll refrain from offering my critique and instead just watch happily as he goes along in his journey of establishing a uniform, simple, understandable process that's not so taxing on the baristas that it ends up taxing the customers, which is what we have now. Again, when you go back to his early days at Chipotle, he could have easily been overwhelmed, but he didn't take counsel of his fears and instead went for simplicity and, again, simple blocking and tackling. He went for process. I don't see a million permutations of drinks continuing. You please all, you please none. So I wish I could say we didn't sell any Starbucks because Brian's got his plan to do this and that and this and that. But it's too early for specifics. We're sticking with the stock because while the task at hand is much bigger than Chipotle, the Brian Niccol we're getting at Starbucks is a heck of a lot better even than the Brian Niccol we got 6 years ago at Chipotle. The benefit experience in that remarkable turn. Time to let Brian be Brian. He'll figure it out, and I bet he does so far sooner than anyone expects. Initially, it might only be in a handful of stores, but when he figures out what works, it'll be in your Starbucks real fast. Fast enough that you'll regret selling the stock now with some sort of chimerical opportunity to buy it back, say, 10 to 12 points lower. I say just strap yourself to the mast and just go along for the sale. I like to say there's always a bull market somewhere, and I promise I'll find just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.